Mortgage delinquencies are spiking, the highest we've seen since COVID, and a lot of these are FHA loans, the low down payment programs first-time buyers rely on. But here's the part that no one's really talking about. The FHA also just quietly rolled back a key rule that kept institutions from jumping the line on foreclosures. For years, Wall Street had to wait 30 days before bidding on foreclosed homes, giving everyday buyers a real shot at a deal. Not anymore. The gates open, race for distressed properties just got a lot more competitive. I've got Jason, co-founder of The Clear Close, with me as usual, and this week we're going to be talking about what's going on with the FHA, new regulations, and to keep things a little bit more relevant to where we live, we'll zoom in a little more and take a look at what's happening in our own backyard in Orange County. What do the numbers say? What does it mean for people still waiting on the sidelines looking to buy a home in the OC? And before we get into it, if you're getting any value out of these videos, please support us by liking the video and subscribing to the channel. Maybe even drop a comment. Anything that engages the algorithm helps a ton, and we really, really appreciate it. All right, Jason, let's get into it. I'm sure you're well aware of what's going on too, but recently FHA just said there was a rule that barred institutions from coming in and bidding on foreclosed homes, and the limitation was 30 days before they could start bidding. But now they reversed that. Apparently, it wasn't that effective. So the implications, we don't know what's going to actually happen, but it could be that people who are waiting on the sidelines with a lot of cash and, prices are so expensive for homes, they're just waiting for foreclosures for an actual good deal, right? And, FHA, when they reverse this, it's like you're going to be competing immediately with deep pocket investment banks or private equity. And, are normal people screwed on this? What do you think?
So it's like every market is a little different. I'm assuming FHA wants to make sure people get into homes. I don't know how that's going to help. It's going to help investors get into homes, but I mean, with foreclosures, maybe they just want it quickly turned off the market or the house turned over so that it can be brought back onto the marketplace and resell for higher.
Yeah. So maybe they think there's not enough cash or liquidity in individuals' pockets, right? So if there's a wave of foreclosures from the FHA, they're gonna need a mass amount of liquidity in the private sector to suck it up, or else they're gonna have to foot the bill, right? Because FHA is government insured.
It's an insured.
So
it's government. It's insured by the FHA. So there's in case of default, they're paying the investor or the bank back on that loan,
right.
a percentage of it. So faster it turns, the more it can lend out, I guess.
Yeah, so if I'm thinking who's in power right now, it's the Doge team, right? If they don't want the government to be spending money, then maybe they are deregulating on purpose so that the private sector with investment banks or whatever, they can foot the bill. They can come in with liquidity and kind of bail out the government in that way. What do you think?
So I thought the 30-day pause before an investor could buy an FHA foreclosed home was so that primary owner occupants that want to make this a primary home gets the first dibs at it. But
exactly, it is. Mm-hmm.
But my guess right now is it's probably not working because it's harder for people to qualify even with an FHA mortgage to borrow at a 6% interest rate.
Right. So that's what I was thinking. Yeah. Yeah. There's not enough liquidity in individuals' pockets to come in and suck up all of the inventory that could potentially be flooding the market when, they just let the doors loose, right? And all these these delinquent homes go on the market. There's not enough buyers, not enough qualified buyers. And at the end of the day, is it so bad if, there's a ton of houses, there's a new owner, but who's going to be occupying it? It's still going to be most likely the family that had the mortgage, but they defaulted. Now they're just renters.
I've heard of stories like that. Some people will come in, buy it, and then rent back the home to the original owner. So, yeah, no, it's someone's going to be in that house. Hopefully,
Right.
a new family that has an opportunity to be able to afford a home. And that was the main purpose of the FHA loan. Don't forget that, Peter, because an FHA
Of
loan
course.
had looser guidelines so that, not in the sense it was looser, but made it easier for people to afford homes because banks and other lenders and institutions knew that our government would come back and protect that investment for the investor. So they made it easier to access home because, like, say for example, an FHA loan, you can technically qualify with as low as a 500 FICO score.
Mm-hmm.
Conventional loans start at 620. So to open the door through a manual FHA underwrite process to get keys to a home with a 500 FICO score, that's pretty amazing. And that's after half the required time for like a bankruptcy, for example, like the seasoning behind it, or even a foreclosure, like a conventional loan foreclosure, you have to wait 7 years, right? With the
So
FHA,
someone who foreclosed on a previous home has to wait
correct.
7 years before they could apply or so qualify for a conventional
Qualify
loan.
for another conventional loan. So like
Right. So yeah, they're
FHA,
renters for 7 years.
exactly. Yeah, you're basically renting for 7 years. It's a major handicap.
Mm.
And it's a sad thing because I'm pretty sure most people that buy homes don't plan to foreclose and not pay on their mortgage. So there must have been a life event that was
Mm-hmm.
catastrophic, right? And it just
Yeah.
snowballed into that circumstance. So that
Yeah.
is, yeah. I,
Unfortunately, the life event that happened for most people that are in this situation is COVID. Like COVID put people in this situation, and
I know it's nuts.
lost a
It's
lot of
like,
people lost jobs and stuff like that.
exactly. And a lot of that was to help protect the average American, the normal homeowner, right?
It was, but my research is showing that the moratorium wasn't like a forgiveness, it was just a deferment. So people who were not able to pay their mortgage on time, it was just tagged on to the back and it became a balloon payment. And now, you know, like it's a real problem for people
Mhm.
who took advantage of the moratorium.
You're still gonna pay for it at the end of the day. They're not getting that money for free. Don't get you
Of
got
course,
can't you got
of
to remember
course.
that because it's tacked on. Like I see title reports all the time, and it's like I know it's a foreclosure because it said HUD, Housing and Urban Development,
Hmm.
lien, second position, third position. Right? It's like some of them I see it for like 50, 60, 70 grand, right?
Yeah.
That customer is paying for it at the end of the day. Like you can't cash out, refinance, or tap into your equity to
Hmm.
refinance without paying off that moratorium because that was your mortgage payment you may not have made for the last 12 to 24 months.
I know, but if think about it from like, I mean, just foot shoe on the other foot. If I was in that position and I knew that I didn't have a job, it's COVID, like the prospect of getting another job is very slim, and there's a lifeline that's handed out. Whatever is on the back end of it, I'll take care of it at the back. I'm signing that paper so I don't get kicked out of my house, right? Like, I think a lot of people were in that position, and they didn't really consider what would happen 5 years down the line. They most likely thought I'll figure it out when I cross that bridge, and now we're at that bridge. We could talk about this back and forth, take different positions all day, but I think just to bring it home and kind of like tie a little bow on it for the listeners. What does this all mean? This is a lot of jargon, like mortgage and real estate jargon, FHA, foreclosures, and all that stuff. But what does it actually mean for people that are in the market trying to look to buy a home, knowing that there could be potential a flood of inventory coming out from FHA foreclosures? And I've been talking to some of my friends, during basketball, whatever. Like they're just houses are so expensive and they're waiting for maybe a foreclosed house to get a good deal. But now with this reversal of the FHA, the rule, institutions being able to bid at the same time as regular people, I don't know, like you're not getting that advantage of the foreclosure sale anymore. Like that discount foreclosures, you could buy a house at like 20-25% discount. But if institutions are coming in bidding at the same time, you might not get that same deal. So, this goes back to something that Jason, Nikki, and I we continually say, get your pre-approvals now. Go shopping now. Like if you're competing with the banks at the time of foreclosures when houses are coming on the market at discounts, they're not really going to be discounted. You're going to be competing, and you might not get that house.
You have to get pre-approved. It's a must. Like I talked to a real estate agent yesterday. She wouldn't refer or offer to put down an offer to purchase land yesterday for a client of mine without a pre-approval letter, because they know the seriousness of presenting that customer to the seller, saying this customer wants to make a legitimate offer. It's not the same as it was 10 years ago before the advancement of the internet and people started getting all this knowledge for free online, right?
Yeah, and if you're pre-approved, it gives you kind of a range of what to look for, right? Because your mortgage originator will tell you, like, this is your range.
This is the payment you can afford or you're comfortable with, and this price point on this pre-approval will give you access to these types of homes. Is it going to give you the access to the home that you want in that budget? If not, then we're going to have to either save more for a down payment or get a little bit more creative with how we structure the deal to make it work. But again, once you get the pre-approval that's fully underwritten, that's going to give you the confidence to know exactly what you're looking for. And as you continue to shop, because last thing you want to see is have a pre-approval done a year ago to find out, hey, you don't qualify this year because you ended up buying a car or something, right?
Yeah, definitely. And keep your pre-approvals updated. Try to get a new one, a new letter every month or so. Let's move on to the next topic, Jason. We have been talking about shifting powers from individuals to institutions. Let's talk about where power is shifting in terms of buyer to seller, or sorry, other way around, from seller to buyer. Are we seeing a shift in California of all places?
I think it depends on region, because our backyard, or my backyard, Orange County, because you're technically LA County, my
Yeah.
backyard here is it's definitely it's been a seller's market, and it has continued to. There's not enough inventory to keep up with demand, and it's always been that way. Like if you look back, like just the last 5 years, we have had a continued steady supply. Supply hasn't changed. It's so that lack of supply to meet the demands of this area have continued to drive prices up, and I think I sent you a screenshot the other day, like from 2008 to now, it's a steady rise from like $400,000 median sale price to 1.4. So it's going to continue to, in my opinion, it's going to continue to go up. There might be little blips here and there, but it's so far as from what I can see on the data, it's always been a historical seasonal pattern. Like you hit your lowest point in December, and then all of a sudden March turns around and just immediately picks right back up. Number of homes coming onto the market, days on market, we're still average 30 days or less. Median 2 weeks. It goes quick here.
hmm But OC is a little unique, right? There's pockets of California that are different from other pockets of California. There's an article by Fast Company, shows a bunch of different counties and what's going on with inventory for sale. More inventory means there's more people trying to sell their home, and less inventory means there's not enough homes on the market, and buyers are going to have to pay a more premium to get to that home because supply and demand, simple. So San Francisco County, anything in the green, we're seeing a rise in inventory. So San Francisco, Butte County, San Mateo, Alameda, Sonoma, Santa Cruz, and anything in yellow. Some of these are actually down, like Shasta County, Fresno, it's coming down. Orange
Not
County,
enough inventory for the demand.
yeah, not enough inventory. So there's a dichotomy here. There's certain pockets where you're gonna probably find a better deal, and you're gonna be able to have more room to make deals, and then other places where, yeah, it's gonna be a little bit tougher still.
What's the time frame for that data though on Fast Company? Because like news articles
Uh,
are there to be
mhm.
news, you know? grab your attention?
Yeah, yeah. Well, this chart goes from 17 to 25. The 2027, I'm sorry,
Or
2017 to
March?
2025. Yeah,
Uh-huh.
March. I mean, data lags, like
Data
there's nothing.
100% lags. Like it's
Yeah.
hard to predict. It's like you're forecasting and trying to. I mean, it depends where you're reading it from. Like for me, it's like every time I read something from the news, it's like, what are they trying to tell me, right? And
Hmm.
what's the main motivation? Are they trying to scare me to get the attention? That's news, right? So
It
it's
is the
like,
news,
but that's
yeah.
the fun part. It's the conspiracy theories behind it. Because like the way I see that data, it looks flat to me. It doesn't. I don't see how San Francisco County. If I see the trend line, yeah, it's up, but it's not up that much, is it? It looks pretty flat.
Well, this is how
On
many years
average,
are we
it's like
talking
hovering right
about?
around 700, you know?
But if you look at the averages here, like let's say the average is like right around here, and then the average is around here. The average
It's
has
going down. There's not
increased.
enough inventory.
No, dude, look. Like let's
I
say
mean, pre-pandemic,
housing.
post-pandemic, different, you know? I see two
Well,
trend lines.
This is pandemic right here, right?
Yeah.
But we're talking about on average, like inventory back in 17, 18, 19 was right around this area, around
600,
let's say five, 600, and then now inventory is coming up to like thousands,
800.
eight
Yeah.
hundreds, yeah. So we're not looking at the peaks and troughs. We're looking at the averages of inventory
Right.
because it's their seasonality. People buy more homes during the spring.
That's the seasonality. If you look at the InfoSparks charts that I gave you the other day
Hmm.
on inventory months of supply, as of March in Orange County, it's lower than where it was in March of 2020, right at the height of the pandemic, you know? And then supply took a sharp decline down to under a month by January of 22. So if I look at that, it could go up here, right? And then set a new high with overall supply, like or inventory. So it's like I'm more curious to see where the data is going to be in June when summertime hits, because I'm seeing a lot of price cuts happening in spring, which is very weird for this market. Like I
So
see
now you're
many
seeing price
homes
cuts now in Orange County.
I'm seeing everywhere. So it's like I'm seeing very active price adjustments. Seeing price cuts on some homes upwards of 5% is remarkable. So it's like, does that make me want to think proceed with caution, or is this when sellers are getting scared, buyers have the opportunity to get a little bit of a deal? Because I'm assuming if they're doing price cuts, they're motivated to sell the property, which means as a realtor, when I write an offer to you in Orange County, I'm not afraid to ask for more sellers concessions, especially if my home buyers are very well qualified. Because if I
Yeah.
see a price cut on a home that's been sitting there 3 weeks and has a 5% price decrease, it's either A, the
Hmm.
realtor over there on the seller side priced the home wrong for the market,
Hmm.
and they're realizing late to the game that they're overpriced now, and it's now a buyer's market potentially. Because I'm seeing like really fixed up, nicely renovated or rehabbed homes, right? That wholesalers got their hands onto, and they're like going for they're priced very aggressively to homes that haven't been touched by original owners in decades. So it's like you can get a fixed up home or fully renovated home for the same price as a seller that has lived in it for the last 50 years.
But if you fix up a home, can't you command more price or a
Not
higher
not
price?
necessarily, not if the market's not going to support it.
Yeah. I guess it depends on what your goal is, right? Like if you're trying to get out of a house because you have another target in mind
Mm-hmm.
and the target is, cost less than your current home, then yeah, you want speed. You want to sell it quick, make a deal, right? Get out of it, make sure your buyer's qualified and the least amount of headache as possible. But
Mm-hmm.
I think the problem is so many people during the pandemic purchased a speculative home or purchased a home thinking it's an appreciating asset, and they're afraid to sell it for less than what they think it's worth or to lose money on it because they've just YOLO'd into a house as like this is my retirement now, right?
Hmm.
Like all my entire life savings is in this house. Everything's riding on this, and the market's crashing. They're like, I want to sell and protect my capital, but I don't want to sell for less and lose my money. And that's such a feel bad situation.
This is like that famous investor quote, right? And it's also something I heard on Ramsey recently too. It's you can't time the market. It's time in the market, right? You have
Mm-hmm.
to look decades. And if this is your house and your home, it's like if you bought it thinking that this was your retirement plan or goal for wealth, right? Building, you only realize that gain or loss if you sell it. What happens in between doesn't matter. So that's what people I think really need to sit down and like think about because if this is your primary home, it doesn't matter if it's going up and down every year, and some years more down than the others. Because like look at the stock market the last 3 years, like 25% increase on the S&P, 22% the following year after that. You're up 50 something percent.
Mm-hmm.
How? It doesn't make sense, you know? And the same goes with home values. It's going to go up and down. Sorry, it's not easy if it becomes uneasy as a homeowner if something changes to where you can't qualify to make that monthly payment anymore, right?
Mm-hmm.
Because you're only realizing the home value, quote unquote, loss if you sell it, right? So if this was a primary home for my family and I have my job and I qualified for it and I knew that I wasn't borrowing, not borrowing, but like I wasn't spending all of my paycheck to make that monthly mortgage payment because to qualify for it, you don't want to be over 30, 36, or 43%, right, of your qualifying household income. So if that doesn't change, you making that monthly mortgage payment and having a roof over your head for your family, it doesn't matter what the market says. Your home can go from 100,000 to 90,000 or 70,000,
Mm-hmm.
but you know what
Right.
your payment is, right? So it's that.
I
It's
Yeah.
Go ahead. What were you gonna say? I'm
Oh no,
curious.
but that's exactly the mindset of people who are not selling their houses right now because market is down. Like, why am I going to sell my house and realize a loss, right? So, and now the industry is in a standstill because exactly that mindset, which is fine. Like that's how people should respond in a down market. Like, I just will sit on my house and I'll live and enjoy my house as long as I have my job.
Exactly. So it's like
Yeah.
it's that's where I think the news tends to scare people into thinking like, oh my God, I'm like realizing losses, but there's no real loss yet because you haven't sold. And it's like your
Mm-hmm.
401k, you're not gonna, doesn't matter if it goes down tomorrow, unless you're actually retired today and making draws on it. That's a different story. But if you're younger, not of retirement age, it's you're gonna see those market up and downs. And when you look at it 20 years later, you're gonna be glad you were in the market versus sitting on the sideline. Because I can tell
Mm-hmm.
you in 20 years, if your home values continue to hold or go up, that's 20 years of rent payment if you didn't buy a house. So if you're
Yeah.
spending in a month on rent, that's 24,000 a year. 10 years, that's $240,000 on rent. 100% interest going somewhere else. Where instead of 20, 30 years later, that could have been your house, you know?
And then you could
Why not?
leverage
As
that
long as it makes
and
sense financially and
yeah.
you're comfortable with that monthly payment, that's the most
Oh,
important.
right.
Don't look at it.
So,
Yeah. Sorry, go
mhm,
ahead.
yeah, go ahead. No, 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 go ahead.
No, I was just gonna say like like don't look at if it's a primary home you're purchasing, don't look at it as an investment because it's not. It's stability that you're buying. Like if I had to go, if this was if I was starting over from scratch, I like Dave Ramsey a lot. It's like I would minimize my debt, qualify, organize, and just restructure so that all I do is focus on buying that house and budgeting and paying it off as fast as possible. Because like
So are you like an advocate of doing additional payments towards a principal?
100%, 100%, I don't want to pay the bank more interest than I need to.
Right. Uh-huh.
There's no way. You don't make minimum payments. Like I get really excited when I meet clients that are like that have budgets and
Mm-hmm.
understand where every single dollar is going, and we can work together to calculate out how to own that home 7 years faster. Or in some clients' cases, they bought a home in 2021, had a $450,000 loan, and because we set up a budget, 2025, 4 years later, they've already paid down 200 grand of that loan.
Mm.
Isn't that amazing? They
Yeah.
paid almost half of their mortgage off in 4 years. That's
So
insane. Yeah.
what's if someone says, "Hey Jason, like why am I gonna pay an additional like what is that payment like another 2-3 thousand a month?" No, no,
It doesn't even have to be that much. Like,
it's
say, for
like
example,
another like $500 a month, right? Let's just say additional $500 in
mhm,
principal payment towards the
you can
mortgage
cut it
every
in
month,
half at that
right?
type of
You would
loan
cut it in
amount.
half.
Hmm.
But what if they say, "I'm gonna put this money into the stock market, and I
No,
could potentially see higher yield from the
mhm.
stock market," or like someone who's really enlightened and forward thinking, they want to put it into Bitcoin, right? If they say, "I'm gonna double my money in 4 years," Jason, why wouldn't I just do that? Why would I pay off my mortgage?
Why? So let's go back to Mr. Ramsey again. This is my favorite because this is what doesn't make sense to me. It's like if you owned your home free and clear, Peter,
Yeah, yeah.
and you paid off your home, would you take out 400 grand and put it into Bitcoin? Because in 4 years, you're going to be able to be what? Would you do that? Would you mortgage the roof over your head where you have no monthly payment, no debt
No, I
to
wouldn't. I wouldn't. That's
That's what I'm
crazy.
saying. I
Yeah.
think that you just answered it for everybody out there. It's like I see so much YouTube professionals, right? I would love to
Yeah.
see their finances. I 100% would love to
Hmm.
see their finances. I bet you they don't even own a home.
Hmm.
Oh yeah, no, they don't. His name's Grant Cardone. He doesn't own a home, right? He just takes everybody else's money. Don't
Shout
buy
out
a
to Grant
primary home
Cardone.
according to Grant Cardone, right? Just give me your money,
Yeah. Oh,
and
dude.
and you'll join my syndication and whatever. No, you can cut that out if you want.
Shots fired at Grant Cardone. It's okay. Um, yeah. So we kind of got off the rails. Um, but let's bring it back home. So, um, how do we even close this out? Jeez.
I don't even know
I
because we hopped all over it. We didn't go. We went through like LA and OC at the same time, but it's hard to, hard not to because it's your backyard versus my backyard. So, like for me personally, tread with caution is my advice because there's so much uncertainty and influence from outside sources that real estate is going to be it's definitely a lagging indicator. Like it could
Mm-hmm.
go either way. Like
Yeah.
this could scare sellers and you might get a good deal based off of what last year's pricing was. But every market's different. I'm a little bit more comfortable in Orange County because I know my market. So it's like if I see an opportunity, what seems like an opportunity, I'm okay with it because I see the appreciation. It's been consistent even through the 0809 crash. I see that appreciation period from to today, it's doubled, right? But it's not the same with other areas. Like I know I pick on Texas a lot or Florida.
Yeah, I think we got to get Jack back on this because I really want to help people who are like kind of in the middle. Like they have a good amount of cash. They just want, they have these targets, but it's so hard to compete with people like full cash buyers, like you said, right? As soon as a decent house comes on the market, like, oh, this fits my needs, boom, it's
Mhm.
gone, you know? And so like I would love to give people like our, the few viewers that we have and at least our friends some good advice
Right.
how they can qualify and not only qualify but um, how they can actually like close a deal on a house.
Again,
So
that's going to come down
mhm.
to getting pre-approved, connecting with a really good loan officer, an originator, and then working and teaming up with the great realtor, right? We got you
Yeah, yeah,
covered. We do both.
absolutely. I think that's a really good place that we can segue into the closing. So again, if you've got any value from this, and if you want to continue to support us, please give us a like. Please subscribe and engage with the algorithm in the comments. You know, anything helps. Sharing, watching the video all the way through, that really helps a lot too, apparently. And there's a link in the description or in the show notes. Get one-on-one free consulting with Jason, Nikki, and I. So once again, we are the Clear Close, and we will see you guys next time. Bye.